For most people, their home is their largest asset. But what most homeowners don't realize, that if life throws a curveball at you, such as medical bills or your house burns down in a fire, they might not be able to access the equity in their home. And that's where a home equity line of credit comes in, better known as a HELOC. It's a financial lifeline, but here's the catch. If you don't set it up before you need it, it might be too late. In this video, I'm going to show you how a HELOC works, why it can protect you from financial disaster, and the mistakes you need to avoid to keep your home and stay in financially good shape. With that being said, let's jump into it. First and foremost, to look at this from a financial management perspective, we break down your finances into three categories: day-to-day money, money for future self, and risk management. Doing this allows you to have a financial management plan that is extremely easy to build and implement. Where a HELOC comes into this financial management strategy is in risk management. So a HELOC, or a home equity line of credit, is often confused with a home loan, but they are not the same thing. A HELOC is actually like a credit card. It's a revolving source of money that you can tap into whenever you need to. However, if you don't ever need to use it, you don't need to pay interest on it. Unlike a home loan where you take the money and the day you take it, you're paying interest. So first things first, how do you access money on a HELOC? First of all, you have to have one open. Lenders can get this for you, but most of your local banks or credit unions are going to have the best offers for you. Now, once you have it set up, you can do a couple different things to access the money. You can do online transfers straight to your bank account. Some HELOCs allow you to write a check straight from the HELOC account, while others actually have a HELOC linked credit card that you can swipe whenever you want to use it and then pay it off like it's a credit card at the end of the month. Not only that, but if you do take money out of it, you could choose between a variable interest rate and a fixed interest rate type of HELOC. That's high level about what a HELOC is. But why do you actually need it? Now, number one is because of an emergency. So for example, if your house burns down, you don't have equity in your house anymore. Therefore, you can't take a loan anymore and access the equity because your house isn't there anymore. However, if you have a home equity line of credit open and your house burns down, you can draw on the money and put it into your bank account, and the bank can't take it from you because you already have it. So that gives you financial flexibility. Or I've seen different situations where somebody has like a medical emergency and they can't work. And although they're getting some disability and some short-term type of payments, it's not enough to actually live off of. And in those cases, if you have a line of credit, you can draw against it. Whereas if you needed a home equity loan, you can no longer get that because you don't have an income. But if you already have a HELOC set up, you can draw against it to help you in the short term, give yourself budget flexibility. Now, beyond emergencies, you can also potentially use it for debt consolidation. So maybe you have like a high interest rate credit card or a high interest rate student loan or a high interest rate car loan. You can use the HELOC to pay those off, and it should be at a lower interest rate, and so you can save money that way. Hey guys, real quick, if you're still watching this video, it's because you're getting value from it. We enjoy making these videos, and when you subscribe to the channel, it helps us grow, which allows us to keep making more and more videos. So if you get a chance, please hit the subscribe button. With that being said, let's jump back into the video. Now, there's two other benefits of having a HELOC. The first is that it shows up on your credit report like a revolving line of credit, which means like a credit card. So you can have this big credit available to you and no balance. That's called the credit utilization ratio, is really good. Therefore, your credit score actually goes up when you have a home equity line of credit and you're not using it. The other part is it reduces the absolute need for an emergency fund because you have access to funds if you need it in the short term. Therefore, more of your money can actually be invested in and working harder for you than simply just sitting in a bank account waiting in case something happens. Now, the next thing you need to know about a HELOC is how does it actually work? Specifically, there's two phases of a HELOC. The first phase is a draw period. And most of the time, a draw period is 10 years. So let's just say I open up one today, the draw period would last 10 years. What that means is any money that I'm taking out of it, the only payments I owe back are interest-only payments. Now, I could pay the whole thing off if I wanted to, but I'm not required to during the draw period. The second period is the repayment period. Once that draw period is over, then you enter a regular repayment time period just like a regular loan. Typically, the repayment time period is 20 years. So for example, during the draw period, let's just say you had a $50,000 line of credit, but you only took out $20,000 of it. After the draw period, that $20,000 is then owed as like a regular loan over a 20-year span. Now, typically, if you don't draw anything on a home equity line of credit, the draw period just keeps going. Or if the bank says, no, you only have 10 years, and then they end the HELOC, even though you don't have anything drawn against it, you can just go get another one and have another 10-year draw period. Now, there's two questions I always get on HELOCs. The first is typically, how much can I actually borrow? How much of a HELOC can I get? Most of the time, banks will go up to 80 or 85 or 90% of the value of your home. So let's just say it's 90%. So let's just say your home is worth $1 million. You could take out $900,000 in loans and qualify for a HELOC still. What does that $900,000 mean? Well, it's actually a component of two different things. If you have a mortgage, say of $600,000, then you can add $300,000 of a HELOC on top of that to hit $900,000. So how much you can take out is a function of how much your home is worth minus what you already owe on it for existing debt, and then how much of that equity can you take out. The other question I always get is, well, what happens if I sell my house? Do I have to pay back that home equity line of credit? Yes. Remember, the line of credit is backed by the house. So just like a regular mortgage, if you sell it, you have to then pay off that loan and that line of credit. Now, as I mentioned earlier, a HELOC is part of your financial management plan. Specifically, there's three categories: day-to-day money, money for future self, and risk management. And a HELOC falls underneath risk management. Now, to understand how those three categories interact with each other and how you can build a financial management plan, be sure to watch this video next.